Hello and welcome to the Friday market update. I got a little impromptu because my computer's not working too great. But anyways, mortgage rates pretty much went sideways this week and remained under 7% since mid-February. They've settled into a comfortable range for now, but as you know, things can change in a heartbeat. This morning, the PCE report, personal consumption expenditure, aka the Fed's favorite inflation measure, came in slightly hotter than expected. Normally, that would push rates up. But Wall Street brushed it off and rates stayed relatively flat. So why the shrug? There are growing concerns that the economy is starting to slow, especially when it comes to consumer spending and the potential tariffs shutting down some of that spending. I've been saying for 6 months, the consumer is on the verge of being tapped out. Credit card debt just passed $1.2 trillion. And with the federal student loan payments resuming in September of 2024, we now have over 9.7 million borrowers delinquent, totaling more than $250 billion in overdue debt. So let's be honest. Many people assumed student loan forgiveness would come through, and in the meantime, rising costs force them to rely on credit cards just to get by. But now the bills are due. The piper is calling. And for some, it's either unaffordability, they can't afford to make the payments, or they're just ignoring it. But here's the catch. Those missed student loan payments are now being reported as late payments, and that's a big hit to credit scores. That means trouble getting new credit, including mortgages, and higher rates when they do. So we're also still navigating global uncertainties, tariffs, Russia, Ukraine, Israel, Hamas, and more. Even with some signs of progress, uncertainty leads to caution. People hold back on big purchases like homes, tightening their budgets and wait it out. But here's what happens next. When the economy slows, rates typically go down. And I believe we'll continue to see a slow and steady decline in interest rates through the rest of 2025. Since April 2024, rates have dropped about 0.75%. And remember, a 1% drop in mortgage rates can potentially bring in about 5 million new home buyers into the market. We're already seeing new buyers come back daily. So just yesterday, I spoke with a buyer relocating from Utah to Vegas. He was worried that unaffordability was going to crush him. He thought house prices were going to crash. He thinks that the prices are just unsustainable. So we talked through the data, housing supply versus household formation, Fed policy, income growth, long-term investment strategies. And at the end of the day, I reminded him, real estate wins long-term. So since 1942, real estate has posted a winning record of 75, 7, and 1. That's over a 90% winning percentage. And every decade since the 1940s has seen home values rise. Even the lowest performing decade, the 1960s, saw home prices grow by 23%. The best? The 1970s with 130% appreciation. And guess what? That was during a time of rampant inflation. Does that sound familiar? So I left them with this. Buy when no one else wants to buy. Or as Warren Buffett says, be fearful when others are greedy and be greedy when others are fearful. Are others fearful right now? I think so. He made the offer. It got accepted today. And agents, don't forget to register for my upcoming event, Winning the Listing Presentation. It's a fresh take from a mortgage pro on how you can really go to the biggest pain point for the buyers, the monthly payment. I'll show you how to use a couple of powerful tools that will help sell your seller's property faster. Register at billgaylord.com/win. And if you want to refer a client, the best way is to start a group text with me and the client using my direct cell 858-776-6830. And I'm available 8 a.m. to 9 p.m., 364 days a year, off on Christmas, maybe Super Bowl too. But try me. Hope you have a fantastic weekend. We'll talk to you soon. Gaylord out.